Hello everyone. We take a stock of macro and market events for May 2022. COVID continues to make some news every now and then. China has seen some improvement in overall COVID situation and supply chains during the last week of May. Chinese policy has shifted to being more supportive of the economy, particularly towards infrastructure investment. Given the headwinds in consumption, property and exports, infrastructure investment essentially is the key driver Chinese government is counting on. But if that is the case, metal prices needs to be watched out. For now, commodities in metal space have corrected in May. Food and energy prices stay high. Brent in particular gets affected by European Union indicating partial ban on Russian oil import, absence of supply from Iran, and less than targeted supply from OPEC nations. Russia's crude is getting diverted to Asia at a huge discount. India's crude import share from Russia has also increased from less than 2% trend to over 10% in last 2 months. Everything else remaining the same, it helps to reduce annual oil import bill by roughly $6 to $7 billion. For food, apart from near absence of export from Russia and Ukraine, countries are also resorting to export restrictions to address their own domestic food security concerns. This adds to global supply shortage. So, for now, in the case of commodity, as overall global growth momentum still holds, supply concerns outweigh the prospects of likely softer growth into the future. That could change in the coming quarters. Secondly, US Fed also delivered 50 basis point hike in May and has commenced balance sheet reduction in June. Policy focus remains on reining in inflation. While Fed chair downplayed the possibility of 75 basis point hike at one go, but indicated 50 basis point hikes for the next couple of meetings is likely. Towards the end of 2022, global growth weakness could seep in as softer late cycle demand collide with tighter liquidity. Coming to the equity market, India underperformed emerging market and global peers. Nifty was down 3% during the month. Performance down the capitalization curve was worse. FIIs continued to sell and DIIs bought yet again. India released its Q4 FY22 GDP growth, which moderated to 4.1%, led by weakness in consumption demand, perhaps reflecting the Omicron impact. FY22 closed the year with 8.7% growth. We expect it to moderate to roughly about 7 to 8% in FY23. This isn't an exciting number if one adjusts for COVID anomalies. It's primarily the inflation and fears of global growth moderation that makes us pencil a softer growth, even as for the medium term we stay positive on India's growth trajectory. Q4 FY22 earnings season also came to a close, and profits were broadly in line with estimates. All the consumption sectors saw moderation in gross and EBITDA margins due to continued high raw material prices. We expect Nifty 50 index to show a profit growth of 14% in FY23, even as earnings estimates are being gradually revised lower. The broader earning trajectory for India remains healthy. In India, equity has seen a derating in valuations. Forward Ps are down roughly 30 to 35% on an average from their last year highs. Yet, when we adjust for the bond yield, they still command a significant premium. With the global rate cycle having commenced, both globally and across major emerging market economies as well, valuation should continue to drift lower. Against this backdrop, near-term caution in equity may be advised. We, however, stay of the view that beyond the near-term turbulence, we are likely at the beginning of new capex-driven economic and earnings cycle in India, and therefore one should use any sell-off in the pro-economy stocks to add from a medium to long-term perspective. Now, coming to the fixed income market. Inflation momentum in most emerging market economies is running double the pace of central bank targets. There are evidences of price pressures broadening in most economies, services inflation recovering alongside the opening of economy. Meanwhile, WPI to CPI ratios are at record high, suggesting that the pipeline price pressures are also elevated. In many economies, food and fuel prices are adding to the risk. After India's headline CPI surged into 7% handle in mid-April, there have been a flurry of fiscal and monetary responses to combat the price pressures, such as an intermeeting rate hike, draining of liquidity, and unwinding of duties on petroleum products, export restrictions, and import tariff cuts. We expect RBI to deliver 75 basis point of rate hikes over the next two policy at the very least, though we remain agnostic about the distribution across the two meetings. OIS curve is pricing in almost 300 basis point of rate hike, taking the repo to over 7% in a year's time. Whether that is achievable will depend upon growth inflation dynamics. But in this context, it appears that market pricing isn't very stretched as yet, and there could be further rise in yields. As such, weakness in duration assets may not be entirely done. To be sure, a hardening of interest rate amidst an incomplete recovery is far from ideal. Actions that government has taken to contain the price pressures has put a tad bit of pressure on its fiscal. We do not know the full quantum of fiscal pressure, and we may know that only during the course of the year. For now, we stick to the stated supply, but this is another area of concern that one should watch out. Given the challenging external backdrop and, more importantly, the shift in RBI's stance and action, the preference for a lower duration stance with focus on adequate liquidity has been broadly appropriate. We would continue to prefer the same stance as the process of adjustment plays out. We would expect opportunities to take long-term investment to open up over the coming months as market repricing continues. Signing off for now. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.